Welcome to the Deep Dive. Today we're plunging into, well, an incredibly dynamic market. Things are shifting really fast.
Yeah, it feels like something significant just hit, and it's forcing everyone to recalculate, basically.
Definitely. And the central challenge, it seems, is how this big geopolitical shock, combined with some, frankly, conflicting economic signals, has put the Federal Reserve in what our sources are calling a policy trap.
That's exactly it. And look, this isn't just, day-to-day market noise. It feels like it's fundamentally reshaping the outlook for investors.
Right. So our mission today is to cut through that noise. We want to clarify these complex, sometimes opposing viewpoints, and most importantly, pull out specific, actionable insights for you, our listener.
We've been digging into this really detailed 24-hour tactical outlook report. It's great because it mixes the big macro picture with some super granular stock-specific stuff.
And the goal is for you to walk away not just, informed, but actually feeling equipped to handle this volatility.
Exactly. And the main catalyst, the report makes clear, is these U.S. military airstrikes, Operation Midnight Hammer, on Iranian nuclear facilities.
This isn't just another headline, then.
No, not at all. The report frames it as forcing a significant Bayesian update in market beliefs. That just means investors are rapidly, changing their probabilities based on this totally new information.
A Bayesian update.
Okay. Yeah, it suddenly makes a potential stagflation scenario much more real, challenges almost everything we thought was priced in.
Okay, so let's unpack this policy trap. The report says our previous idea, the hope for a soft landing and a Fed ready to cut rates, that's been forcefully challenged. What exactly flipped the script?
Well, it really comes back to Operation Midnight Hammer. This isn't just like a temporary blip. It's potentially stagflationary.
Stagflation, right?
Yeah.
Rising inflation, slowing growth, tough combo.
Really tough. And this event, it adds a real risk premium to energy prices, threatens global supply chains. It just directly undermines that whole cooling inflation story that was supporting the market.
Even though oil prices pulled back a bit.
Yeah, they did pull back from the initial spike because Iran didn't immediately shut down the Strait of Hormuz. But the structural risk, the chance of escalation, that's still there. It changes the energy price outlook going forward.
So where does that leave the Fed? They just held rates, maybe thought things were getting clearer?
And now, bam, they're caught in this policy trap, as the report puts it. They've got these two mandates pulling in opposite directions.
Okay.
So on one hand, you had data from before the conflict, the leading economic index falling, housing starts down nearly 10%, retail sales slumping, all pointing to slowing growth.
Which argues for cutting rates, right? Easing up.
Exactly. But then boom, this new sudden inflation risk from the conflict hits.
The supply side shock.
Precisely. Pushing energy, pushing headline inflation higher. So remember that Fed official who said they'd only support a cut if inflation stayed contained? Well, that's much less certain now.
So the odds of a clean, soft landing just dropped significantly.
Way down. And this creates a huge dilemma for them and something for you to really think about. If they cut rates to help growth, do they end up accommodating this new inflation?
Risking reigniting it.
Right. But if they hold firm, stay hawkish to fight inflation, do they push the economy into a hard landing, maybe even a recession?
That conflict.
Yeah.
It just makes a policy mistake seem much more likely.
Definitely elevates the probability, which is why, as the report highlights, Fed Chair Powell's upcoming testimony to Congress is suddenly this massive high-stakes event.
How they navigate this message is going to be critical.
Absolutely critical. And looking short-term, like the next 24 hours, the report lays out 3 scenarios. Hawkish risk-off, about 30% chance.
Okay.
Neutral consolidation, that's the base case at 50%, and then dovish risk on, lower probability, 20%.
So the middle ground, cautious consolidation, seems most likely for now, reflecting all this uncertainty.
Exactly. Lots of uncertainty.
Okay, so from that big, kind of dizzying macro picture, let's zoom in. How does this actually play out in specific stocks? The report uses what it calls a first principles approach here, which sounds interesting.
Yeah, it picks stocks that really embody these key market themes we're talking about. Each one is like a little case study.
A real-time test. I like that. Okay, this is where it gets really interesting for me. Let's start with Tesla. The robotaxi launch in Austin. The report calls it a watershed moment. What's the deal with TSLA?
Well, the core thing is this is the first tangible delivery on a promise Musk has been making for years, right?
Right, the self-driving future.
Exactly. So the market's reaction isn't just about the news itself. It's like a live referendum on whether investors actually believe he can pull off these huge tech leaps, especially now with sales slowing and, other controversies
This
swirling.
is like a real battleground for sentiment.
Oh, definitely. You've got this primary bullish loop. The initial news hits, social media explodes, influencers, investors on X driving retail FOMO.
Fear of missing out.
Yeah. Price spikes, volume surges, then mainstream finance media picks it up, amplifying it all.
Okay, the bull case.
But then you get the secondary bearish loop, videos start popping up like that one of the robo-taxi trying to drive into the wrong lane.
Oof, not good.
And skeptics, short sellers jump on that, circulating it, raising real questions about readiness, about safety. It fuels the counter-narrative. Plus, technically, the stock got really stretched, the RSI, that momentum gauge, shot way above 70. Overbought.
So, bullish hype versus execution concerns. How does the report suggest we interpret this? What's the key takeaway here?
Well, the report notes that the market's initial reaction, that big price surge on high volume, that's the most powerful signal for now.
Okay.
It suggests capital is prioritizing the long-term story, the fact that the service exists over these early glitches.
So narrative over reality, at least initially.
Kind of. The bullish sentiment is weighted more heavily, but they only give it 65% confidence, meaning it's still very fluid.
Right, could change quickly.
And the broader insight, maybe the aha moment here, is that for these super hyped tech plays, the market often rallies first on just the proof of concept, the idea being real.
Phase one, as you called it.
Exactly. But that sentiment can flip fast once the novelty wears off and people start looking at the actual quality, the scalability.
So the strategic implication is, watch out for phase two.
Pretty much. When the focus shifts to quality safety, reliability, how fast they can actually expand, the report warns that just one high-profile negative incident could have a really disproportionately large downside impact, an asymmetric risk.
Got it. So for an actionable plan on Tesla, the report suggests a bullish momentum strategy.
Yeah, looking to potentially buy dips near specific support levels, like around $330, $355, but only if it holds key indicators like the one-day VWAP on a pullback. Clear price targets, $350, $365, and a stop loss below $325 are crucial.
And that's rated at 60% probability with a decent risk reward.
Okay. Potential gain outweighs the potential loss, about 2.5 to 1.
Okay, next up. Supermicrocomputer, SMCI, key AI infrastructure player. But, the news here isn't exactly bullish, is it?
No, definitely not. The catalyst was their announcement of a big $2.0 billion convertible senior note offering.
Right, convertible debt, potential dilution down the road for shareholders.
And the market hated it. Stock dropped nearly 10% on huge volume, left a nasty bearish gap down on the chart.
So the conflict here is pretty stark.
Yeah, you've got the clear bearish dilution signal, the fear of those future shares hitting the market, driving that immediate sell-off on volume way over double the average, versus the underlying bullish narrative, which is still strong, right? They're a key hardware partner for NVIDIA. They're seen as one of those picks and shovels plays benefiting from the whole AI build-out.
So how did the market resolve that conflict? The reaction seems pretty clear-cut.
It does, and that's the insight. The report says the immediate severe negative reaction is just an unambiguous signal. For now, the fear of dilution, and maybe more importantly, questions about the capital intensity of their business.
Meaning how much cash they need to keep pouring in to grow.
Exactly. Those fears are just overwhelming the positive NVIDIA association in the short term. The bearish signal is dominant here, 85% confidence, according to the report.
So the aha moment is that even in a hot sector like AI, the financing and business model realities can suddenly trump the narrative.
Absolutely. It shows how quickly the market can pivot when faced with the costs of growth.
And this feels bigger than just SMCI's financing choice.
It really is. The report calls it a stark signal of the immense capital intensity of this whole AI infrastructure arms race. Think about it. Chip designers like NVIDIA, they have amazing margins. But the hardware assemblers, the guys like SMCI putting the servers together, they might face margin pressure and just this relentless need for capital spending.
Raises questions about long-term profits for the picks and shovels guys.
It does, and the report even suggests it could be the basis for a pairs trade.
Long the capital light player, short the capital heavy one.
Potentially. Long NVIDIA, short SMCI, for example, is a way to play that theme.
Interesting. Okay, so for SMCI, the actionable plan is bearish continuation.
Yeah, looking to potentially short if it breaks below a key level, say $40, ideally with high volume confirming the breakdown. Targets are lower, around $38 than $36.50, with a stop loss if it closes back above $42.
And that has a high probability 80% with about a 1.75 to 1 risk reward.
Right. Still a decent setup,
Yeah.
probability-wise.
Okay, lastly, Hims and Hers Health. Hims. This report uses some strong language, calls it an existential crisis. What on earth happened there?
Yeah, this one's pretty dramatic. The catalyst was just brutal. Their partnership with Novo Nordisk for distributing Wegovy got terminated.
Wow, the weight loss drug, that's huge.
Huge. And on top of that, accusations of deceptive marketing and news of a securities fraud investigation being launched. It's a direct hit to their whole high-growth model.
Okay, that sounds bad. Where's the conflict here? Is there any bullish case left?
Well, the conflict is technical versus fundamental. Technically, the stock plunged so hard its RSI went deep into oversold territory, like below 30. Normally, you'd think, okay, maybe due for a bounce.
It's the classic oversold bounce setup.
Right. But that's colliding with this absolutely catastrophic fundamental breakdown. Losing the Wegovy deal, being accused of selling illegitimate drugs, the fraud investigation. It's not just a setback. The report calls it a potential existential threat to a core part of their business.
So the big question again. Technical screaming buy the dip versus fundamental screaming get out. Which wins? What's the clear takeaway for us?
The report is crystal clear on this one. Fundamentals utterly dominate here. When the news is this bad, potentially threatening the company's survival, those technical oversold signals are basically meaningless.
Just reflect panic selling.
Exactly. They're not a reliable indicator of a bottom. The bearish signal is overwhelmingly dominant, 95% confidence, the insight. Never trust technicals alone when the fundamental story completely collapses.
That seems like a crucial lesson. And the implications feel broader than just Hims.
Oh, absolutely. The report frames this as a major flashpoint. It's the collision between fast-moving telehealth innovation, that whole move fast and break things tech culture, and the super-regulated world of big pharma and healthcare.
The tension between disruption and rules.
Precisely. And the report predicts this event is highly likely to trigger a big FDA review of compounding regulations.
Ah, the rules around custom mixing drugs, which is a gray area some digital health companies operate in.
Exactly. If regulators clamp down on that, it could create a serious, long-lasting headwind for that whole segment of the digital health industry. It actually presents potentially a sector-wide short thesis.
Wow. Okay, so for Hims itself, the plan is also bearish continuation.
Yes. Looking to short on a break below support, say $41, needing sustained high selling volume for confirmation. Targets lower, maybe $38, then $35 stop if it closes back above $44.
This one has a 75% probability, but the risk reward is closer to 1 to 1. So less potential profit relative to risk compared to SMCI.
Right, reflects maybe some expectation that a lot of bad news is already priced in, or the potential for sharp, unpredictable bounces is higher.
Okay, so stepping back, thinking about those second-order effects,
Yeah.
these examples really highlight bigger themes.
They do. SMCI shows us the huge capital costs behind the AI boom. HIMSS flags the growing regulatory storm clouds over telehealth.
And going back to the start, Operation Midnight Hammer actually provides a tailwind for defense tech, right? Not just the big names, but the whole supply chain.
That's a key thematic takeaway mentioned. And the report actually ranks these opportunities, gives them a net advantage ranking.
Oh, useful.
Yeah, it helps prioritize. It points out that another bullish setup mentioned elsewhere in the report, on Exelixis, along with the two bearish plays we just discussed, SMCI and HIMSS seem to offer the clearest, highest probability trades right now, even with all the market uncertainty.
Good to know where the clearer signals might be. And it's crucial to remember which pieces of information are still developing, right? The live signals.
Absolutely. Fed Chair Powell's testimony, that's top of the list. How does the Fed talk about policy now, post-Iran conflict? That's live.
What else?
The Tesla robo-taxi story in Austin, every video, every update on expansion or problems, that's live data impacting sentiment. And obviously the legal and regulatory mess for Hims and Hers is still unfolding. That's very much live.
So those are the things demanding your real-time attention as a listener.
Exactly. Vigilance is key there.
Okay, so we've taken a real deep dive today. From the macro shockwaves hitting the Fed, putting them in that policy trap, down to the nitty-gritty of how Tesla, Supermicro, and hims and hers are wrestling with their own conflicts and challenges.
We've tried to clarify those opposing forces and give you some concrete strategies to think about.
And beyond just these specific trades, I think this deep dive really underscores how fast major events can force us to just update our entire investment thinking.
It really does. Which leads to maybe a final thought for you to chew on. How might these ongoing geopolitical pressures, these tech breakthroughs like AI and robotaxes, and this rising regulatory scrutiny, how might they fundamentally reshape your own long-term investment approach?
What assumptions that you hold right now might you need to challenge in the coming months as these stories play out?
That's the big question to keep asking yourself.
Absolutely. Well, if you want the fastest updates, the most frequent insights, and more deep dives just like this one, please make sure you subscribe to The Deep Dive.
We're here to help you cut through all the noise and hopefully stay ahead of the curve.